This conference will now be recorded.
Hello and welcome to the Harts October Budget 2021 webinar. I'll start with a quick disclaimer. The following presentation is produced for general guidance only, and professional advice should always be sought before any transaction is undertaken. Individual circumstances can vary, and therefore no responsibility can be accepted by Harts Limited or any of our affiliates for any action taken or any decision made to refrain from action by attendees of this webinar. So we'll start with the key themes of the budget, and there were actually very few announcements relating to tax, or at least very few announcements that concern business owners themselves. Yes, the Chancellor made quite significant changes to alcohol duties, tonnage tax, airport departure taxes, but very few of us will deal with those on a day-to-day basis. This webinar focuses on those which have broad application, and as I say, there were few of those. As a consequence of the budget being as quiet as it was, something which perhaps isn't a surprise given we'd had big increases to corporate and personal taxes already announced this year, both corporation tax and then the health and social care levy, it's perhaps not surprising that this budget was quieter. We're therefore going to spend the second half of this webinar looking at how those changes previously announced will affect the overall tax paid by business owners when extracting money from their businesses. There were, however, a couple of themes which were running through this budget which do affect business owners. The first one is that there are significant pay increases for the lower paid. We see that through the above inflation increases in the minimum wage and living wage, which we'll come on to. But the employees will also see that through the reduction in the taper for their tax credits or universal credits. There was also some ongoing support for the retail, leisure and hospitality industries, coupled with a reform of business rates. And together with that, there were some technical changes, some of which do have some broader application and which we'll cover during the course of this webinar. So starting with the changes to the minimum and living wages. The government is keen to see work paying. They want people in work, and as a consequence of that, there were a lot of noises about transforming, should I say, the UK to being a high wage economy. As a part of that, we've seen, or we will see, very significant increases made to both the minimum and living wages from April 2022. I'll go through the new rates in a moment, but a couple of points that are definitely worth mentioning to everyone and everyone should be aware of is that firstly, care really does need to be taken with salaried employees. From the payrolls we run, we see a lot of individuals who might be on a salary of somewhere between £16,000 and £18,000 a year. Those employees, if they're working a 37.5-hour week, would actually be below minimum wage from next April. Yes, that might come as a surprise to you, but a lot of salaried employees, we do now need to consider minimum wage. There's a worked example on the screen in front of you that a salaried employee working a 37.5-hour week would need to be paid a salary of £18,632 a year from April for that to be compliant with the minimum wage. Alongside that, HMRC do undertake minimum wage audits. If you get one, they're time consuming and the punishments for non-compliance are severe. The revenue will try and look at how many hours people are doing, That's easy for an hourly paid employee. They're clocked in and clocked out. We've got a number of hours and we multiply it by their hourly rate. For a salaried employee, do you know how many hours that person has done? Do they do timesheets? Do you have any kind of time system? Without it, you run the risk that your salaried employee on close to minimum wage, actually the revenue you want to argue is below minimum wage, because they get a 200% penalty from you even for a minor and inadvertent error. And you also get your name put in the public domain as someone who has not paid the minimum wage. So it really is worth looking and making sure that your employees, salaried and hourly paid, are compliant with minimum wage, particularly with the increase coming through. So my next slide here shows the rates for the minimum wage or living wage rates from next April. So individuals aged 23 and older will receive £9.50 an hour. That's up from £8.91 at the moment. That's 6.6% increase. 21 and 22-year-olds will receive £9.18 per hour, up from £8.36. That's actually close to 10%. The percentage increases for the 18 to 20-year-olds and 16 to 17-year-olds are smaller and are shown on the slide at the moment. Apprentices too see a very significant increase from £4.30 to £4.81 per hour from April. What this means is most minimum wage employees see a rise of at least 6.6% and some more than 10%. As well as the salaried employees that I mentioned previously, we will find that more employees as a consequence of this are likely to be on the minimum wage or very close to it. We also expect that as a consequence of there being more significant pay rises being required at the bottom end of the earnings spectrum, that employers will want to maintain pay differentials. It's difficult to justify someone who has more responsibility being on the minimum wage and the same as someone who has zero responsibility. So the likelihood is that this will create wage and salary increase pressures further up the income spectrum. And that's before we start thinking about the consequences of general labour shortages. The next key theme, as I mentioned, was support for the retail, hospitality and leisure sectors. So business rates, the increase in multiplier for the 2022 to 23 year has been cancelled. This means that you'll pay the same business rates next year as you have this year. The government has also announced a 50% discount on business rates up to £110,000 for businesses in the retail, hospitality and leisure sectors. Of course, these were the sectors that were hardest hit by the COVID restrictions and closures. So perhaps with furlough having ended, this is the last part, and actually with the VAT rate going back up for hospitality and leisure, this is perhaps the last part of support that is yet to be withdrawn from the government. The government has also announced that business rates revaluations will take place every 3 rather than every 5 years as part of a general reform plan, which also includes new reliefs to encourage property improvement. One of the criticisms of business rates is that they don't take account of rapid changes in the value of properties. I think the idea here from the government is that they should be more flexible. So if we move on to some of the technical changes that have been announced to business taxes. The first of these is to the annual investment allowance, which is now going to remain at £1 million until the 31st of March 2023 and will remain in place alongside the super deduction. Some of you might be wondering why the annual investment allowance remains important. Previously, it was expected to drop significantly as at December this year. And the reason you might be wondering that is because the super deduction gives you 130% of the cost of new plant and equipment against your taxable profits, whereas the annual investment allowance only gives you 100%. The answer is that the super deduction is much narrower in scope than the annual investment allowance. The annual investment allowance applies to pretty much all plant and equipment other than cars. The super deduction is at 130% on most equipment, but as well as cars, excludes items such as heating systems, electrical wiring, heating and water systems, things that you might be spending quite a lot of money on if you're doing a property, and which are known as integral features. Those items do receive a super deduction, but it's 50%, not 130%. So if you're doing that, the annual investment allowance remains valuable. It's also the case that the annual investment allowance is available to sole traders and to partnerships and LLPs, whereas the super deduction is only available to companies. So this change means that almost all businesses will be able to receive at least 100% tax deduction, 100% of the cost of new plant and equipment as a tax deduction against profits until March 2023. The only significant exceptions will be for matters such as cars and buildings themselves. The government has also announced a reform of research and development R&D tax release, which will take place from April 2023. The list of qualifying expenditure will be broadened to include the purchase of data and cloud computing costs. The government has also announced that it will seek to refocus the support on innovation. It's not 100% clear what they mean by that. It might be that they tweak the rules on what qualifies to focus on more innovative projects. It might be that they tweak the rates. They've also announced that they will be targeting abuse and improving compliance with the regime. Yes, this is a regime which the government wants businesses to claim, companies to claim. They want people to be doing R&D. However, the government obviously doesn't want to be entertaining spurious claims. If Harts do your R&D claim for your company, then the first questions we ask will always be to work through and to confirm that what you're looking to claim is a genuine R&D claim. Only after we're satisfied that what you're doing is genuinely R&D for tax purposes, then we would move on to calculating the claim and submission. However, we are aware that there are unscrupulous providers out there who will put in spurious claims on a percentage of the fee, and the government is very much trying to target that type of behaviour. The other significant change impacting businesses relates to those which are within the scope of income tax. So that will be your sole traders, your partnerships, your limited liability partnerships. Those businesses currently prepare accounts to whatever period in the tax year they want to, and they're taxable based on profits running to that date. So as an example, we're currently preparing tax returns for the 20 to 21 tax year. If you're a sole trader, or if you have a partnership or LLP that pulls together its accounts to April each year, your 20 to 21 tax return will include your profits for the year to April 2020. Similarly, if you did your accounts to March, your tax return would include profits for the year to March 21. This gives businesses who use an April year end a very, very long period of time before they pay tax on their profits. The government appears to be keen to bring forward tax payments and has therefore announced that all businesses will pay tax on their profits based on the tax year, so April to April, 6th of April to 5th of April, from April 2024. The transitional year will be the 2023 to 2024 year, and businesses who use an accounting date other than the 31st of March or 5th of April will actually pay tax in that year on as much as 23 months of profits. Yes, the overlap relief, so some of those businesses will have paid tax twice on some profits potentially years back when they set up, so that relief will be given. However, we would expect that a number of sole traders and partnerships will, because of this transition, have significantly raised profits and therefore significantly raised tax bills for the 2023 to 24 tax year. In addition to this, the government has announced that they will be bringing in Making Tax Digital for income tax from April 2024. What this means is what you do for VAT, you'll also have to do for income tax. Don't know a huge amount more detail yet, other than they're looking at all businesses subject to income tax, and that includes buy-to-let portfolios subject to income tax from April 2024. So anything over £10,000 of turnover from April 2024, we're going to need to look and see how this develops in terms of what quarterly updates and what level of detail is going to be required to be given to the revenue. We'll now move on to a few personal tax changes that have been announced in the budget. The first one, which will be of interest to anyone who has or is thinking of disposing of a second property, whether that's a buy-to-let or a second home, or potentially even your own home if you've not lived in it as your only or main residence throughout the period of ownership. Until last week, you had to report and pay the tax on a disposal of such a property within 30 days. That period has now been extended with immediate effect to 60 days. This is actually a great help because it can take 30 days or close to 30 days to get the reporting process set up with HMRC. And that's before you run into any difficulties with the calculation of the tax itself. So it does remain the case that if you are selling a second home, a buy-to-let property, a holiday home, or your main home, if it's not always been your only or main residence, then you need to tell us either before you sell it or immediately afterwards, because yes, we do still have to calculate, report and pay tax quickly. However, the chance of you being fined if you do that, because we can't get there in 30 days for whatever reason, is much reduced because we're now given 60 days to do that. There was a lot of speculation in the run-up to the budget that there would be major changes to capital gains tax rates or allowances. I think nothing was announced in this year's budget, although I think it still has to be the case that it might happen in the future. But for the moment, there is nothing for the next tax year that we need to be aware of. No changes were announced to capital gains tax rates or allowances. Similarly, there were no major changes to pension tax relief. There were some minor changes to how contributions from lower earners might be treated, but for most people, they do not need to concern themselves with those changes. You can still put in 40 grand a year tax-free. The lifetime allowance remains in place and the 40 grand a year annual allowance remains in place. There are also inflationary increases to national insurance thresholds, albeit income tax allowances remain frozen, as was announced at the March budget. This final slide within the first section of today's presentation is a reminder of income tax rates for this year. The personal allowance remains frozen at £12,570. The higher rate threshold is frozen at £50,270, and the higher income child benefit charge kicks in from £50,000. This means that there are a small number of basic rate taxpayers who are now subject to this charge. The amounts involved will be small, but we can see this causing problems because the high income child benefit charge has always been billed as something that applies to higher earners. Basic rate taxpayers don't normally consider themselves to be higher earners, but they are caught by this charge now. Capital gains tax, inheritance tax. The annual exemption remains at £12,300 until 2025-26, and the inheritance tax nil rate band remains at £325,000 again until 25-26. In addition, the VAT compulsory registration threshold is remaining at £85,000. The government has announced that this will be the case until 2024. So we'll now move on to the second half of today's session, which focuses on the impact of the increases in corporation tax and in national insurance / the health and social care levy, and on taking money out of businesses. So I'll start by going through a reminder of the previously announced tax increases. The headline corporation tax rate goes up to 25% from April 2023. There will remain a lower rate of 19% for the smallest companies. However, it's worth noting that this 25% rate will apply to all companies with profits above £250,000. It will also apply to all investment companies. So that includes a company that undertakes buy-to-let activity. It will also apply at a lower threshold if you have multiple linked companies. So if you have two companies, that £250,000 threshold will be divided in two, and the 25% rate would apply on profits above £125,000. As a consequence, we expect that a large proportion, if not the majority of companies, will be paying at 25% from April 23, or at a rate close to that level. In September, the government also announced that there would be an increase in both employee and employer national insurance contributions of 1.25% from April 2023. This increase is renamed as the Health and Social Care Levy from April 2023, at which point national insurance contributions are meant to drop back down to their current level. Not fully sure of the reasons for the renaming. It might be something to do with how they want to apportion or allocate the receipts from that tax to the NHS or possibly the social care sector. It could be because they want to apply this 1.25% to pensioners who are still working but don't want to put national insurance on them. We don't know, but for all intents and purposes, for most people, what you're saying is an increase in national insurance of 1.25% from April 23 for employee and employer, and this is effectively permanent, even if it's under a different name from the following year. There will also be an increase in dividend tax rates of 1.25% across the board from April of next year. So in terms of how that affects how you might draw money, it's worth considering the total effective tax rates. So this is looking at, if you've got £100 of income, how much tax would you pay on taking it out of your business? At the lowest end, we've currently got rent or interest. So this might be the case if your company owes you a lot of money because you've got a significant director's loan account, or because the company rents a building from you that you own personally, or it could be your buy-to-let income. So at a basic rate, you're paying tax at 20%, higher rate taxpayer 40, top rate taxpayer pays 45. If the business operates as a sole trader, you are still paying income tax at those rates of 20, 40 and 45. However, you're also paying national insurance. So the tax rates increase to the 29, 42 and 47 in that table. If you're a limited company, operating through a limited company, and you choose to take your income in the form of pay as you earn, then you get a corporation tax deduction for the money you take out. However, both the company and the individual pay national insurance, and as an individual, you also pay income tax. If we put all of those income taxes and national insurance contributions together, if you wanted to take £100 of profit out of your limited company, you pay an effective tax rate of about 40% as a basic rate taxpayer. So that includes your income tax, your employee national insurance and your employer national insurance. At higher rate, it goes up to about 49, and at top rate, it goes up to 53%. That's at the moment. Now, I would at this point just caveat that if you're not paying national insurance because, for example, it's the first £9,000 roughly of employment income, or because you're above state pension age, then the tax rates are lower. On the first £9,000 or thereabouts, so within the national insurance nil rate band, the position is the same as for rent or interest. And that is why, if you're operating through a limited company, you do take a small salary, but you don't go higher than that low level, because then those rates which apply to pay as you earn kick in. In excess of that, we normally advise business owners to take the remainder of their funds out in the form of dividends. Dividends don't achieve a corporation tax deduction, but they're subject to a much lower rate of personal tax. So if we take together the corporation tax which you pay on that £100 of profit and the income tax which you pay personally when you take it out, we come with a total effective tax rate of, at the moment, about 25% for dividends if for a basic rate taxpayer, about 45% for a higher rate taxpayer, and about just under 50% for a top rate taxpayer. So this means that for most business owners, it's still best to take a small salary and the remainder in dividends. Next year, the tax rates increase. This is because of the higher rate of national insurance, which is payable by both employee and employer. The table in front of you shows the higher rate, the total effective tax rates, which will be payable on the same sources of income from next year. As you can see, there's an increase of 1.25% on the total rates if you are operating as a sole trader, or for that matter, as a member of a partnership or of an LLP. If you're taking money out to pay as you earn, the increase in tax is more significant because you pay both employee and employer national insurance contributions if you're the business owner. However, due to the way that they're calculated, the increase in the total tax rate isn't 2.5%. It's a little less than that. And the complexities of the calculation are why it's not the same at each tax rate, as each tax band. Dividends go up by, the tax rate on dividends goes up by 1.25%, but you're paying that on the tax rate, on the profits after corporation tax has been deducted, which is why the tax rate isn't as much as 1.25%. But all in all, there is a small increase in tax rates across the board, except for on that first £9,000 taken as salary, 9,000 or thereabouts below the national insurance limits, or the rent or the interest income. So you might want to bring forward profits a bit into the current tax year, but it's not the end of the world. You're talking a 1, possibly 2% increase top side. However, if we roll forward to the following year, April to 2023, we see a much more significant increase to the total rate of tax applying to dividends. This tax rate doesn't affect sole traders or those taking money out by way of pay as you earn. And the reason for that is sole traders, members of a partnership, don't pay corporation tax. So the increase in corporation tax to 25% doesn't apply to them. Similarly, if you take your money out as salary through the PAYE system, the company achieves a corporation tax deduction for that. So an increase in corporation tax doesn't increase the total tax bill. The corporation tax rate only increases the rate of tax that you pay on dividends, and it increases it significantly. These figures assume a 25% corporation tax rate. If your business is paying at a lower rate, the total effective tax rate on dividends will be lower, and it will be somewhere between the 2022 and 2023 rates. But as I've said earlier, we assume, or we expect, that most businesses, or certainly most businesses that we deal with, will pay corporation tax at a rate of 25%, or will pay at a rate close to 25%. And that's why we've used these figures in this spreadsheet, in this slide. As you can see, there will still be a benefit for basic rate taxpayers from taking a small salary and the majority of their money in dividends. However, once you become a higher rate taxpayer or top rate taxpayer, actually once corporation tax has been increased to 25%, then there's very little difference in the overall tax burden between pay as you earn salary and dividends. That doesn't mean everyone should immediately in April 23 go and start taking a pay as you earn salary. What it does mean is that we need to consider profit extraction more carefully. The position that we've enjoyed for the last large number of years, for a very long time, is that in almost all cases it's a no-brainer to take a small salary and the rest in dividends. There's a tax advantage to doing so. Going forward, that's not so obvious, but dividends will still be important for many business owners. For example, if you're not drawing all of the profits, you want to be leaving them in the company until you want to draw the money at a later date. That means you pay the corporation tax rate of 25%, and the personal tax can be deferred until you need the money. So whereas if you operated as a sole trader or as a partnership, you'll be taxed on the profits as they arise anyway. So yes, you are looking at a higher tax rate, but do you need the money out? If the answer is no, then dividends still make sense. Similarly, operating through a limited company gives opportunities for splitting income with a non-working or lower earning spouse. If you're taking a salary, that's your income. If you take dividends, the business could be owned 50-50, and the 100 grand, shall we say, that you're taking a year could be split 50-50. 100 grand taxable on one individual gives rise to a large amount of higher rate tax. If it's split between two individuals who both have a total of 50 grand a year, there's a big tax saving. So a limited company will still make sense for many business owners, but it is also, particularly if you're setting up, going to be worth looking at partnerships and LLPs, because the overall tax burden, if I scroll back up, is going to be several percentage points lower. So let's look, if we look at the sole trader line, it's lower than dividends across the board. Or you might just decide that, for simplicity, that with the increase in tax rates, there will be some people for whom it's better to just go pay as you earn. The tax is deducted at source. It's not particularly tax inefficient from April 2023 for a business owner who is drawing out their income, and you go down that route. They're also worth looking from a planning perspective. Do you bring forward profits to make use of lower tax rates? For example, in many businesses, is there opportunity to have a good year before April 2023? Are you not currently recognising stock or work in progress as its true value? Should you correct that position and take opportunity to correct it and pay the lower tax on the additional income that will generate? It makes these tax rises make pension contributions and the tax advantages associated with those even more valuable. So pension contributions receive a corporation tax deduction. The pension scheme doesn't pay tax. The growth as they're invested is tax-free, and then when you come to take them out of the pension, 25% of that is tax-free, and the remainder is taxed as income, but doesn't attract any national insurance or any other levy. So actually the effective tax rate on pension contributions is only 3/4 of the amount that is on rent or interest. So 15%, 30%, etc. You're not going to get much more tax efficient from that. The downside, of course, is that the money is locked up until you're 55 or 57, depending on your age. It also means that we might want to look at how money is taken out. If you've got a big director's loan account and credit, you've put a lot of money into the business. It means that you perhaps might want to look again at charging interest on that loan account, because it becomes a very tax efficient way of getting money out. Similarly, if your business rents a property you own personally from you, again, looking at that rent becomes an efficient way of getting money out of it. I would also say that the increase in corporation tax means that the equation over whether you want to hold buy-to-let properties personally or through a limited company changes again for some people. 25% corporation tax on rental profits from £1 of profit. If you're taking the money out, that's getting expensive, looking at the tax rates on the previous slide. Do you actually want to hold them in your own name again? The answer to that one is not simple, and it will depend on your personal circumstances, what other income you've got, whether you're holding the properties for income or for gain, whether they're heavily mortgaged. So it is something we would need to talk to you about on an individual basis, but these changes do change the balance of where it makes more sense to hold them from a tax perspective again. And so after all of that food for thought, I'll move on and give a quick advertisement to our next webinar, which is on business planning and which will be given on the 16th of November at 9:30 AM by Stephen Glaisher. And then if anyone does have any questions, please do get in touch with us and we will look to answer them for you. Thank you very much for listening. This is the end of today's webinar.